This is ALBrooks, and this is my price action trading course. The current module is about breakouts and gaps. So what exactly is a breakout? It is the strong phase of a trend. A trend can either be in a spike, which is also a breakout, and a strong trend, or it can be in a channel. These three terms, spike, breakout, and strong trend, are three different phrases to describe the exact same thing. So what exactly is a breakout? Remember the market cycle. The market goes from breakout to channel to trading range and then another breakout. The breakout is the strongest part of the trend, the initial part of the trend, and it's followed by a channel, and that evolves into a trading range, and then there's a new breakout. Every trend bar that you see on the chart is a breakout, and it's also a spike, and it's a gap, and it's a climax. I'll explain that later in the module. What can a breakout look like? It can be a single, unremarkable trend bar, and it could lead to a big trend. It can be a large trend bar. It can be a series of big trend bars or small trend bars. And a breakout of what? A lot of times beginners won't see what the breakout is from. An obvious thing would be a trading range. Another would be a pullback within a trend. You can also break out above a trend line, and you can break out above or below a moving average. A breakout can simply be moving above the high of the prior bar or below the prior bar, or above a prior high on the chart or below a prior low on the chart. What happens if you don't see what the breakout was from? It really doesn't matter. If you see a trend bar, there's a breakout. And with experience, you will be able to see what the breakout was from. Understanding breakouts and how to trade them is one of the most important skills you can develop as a trader. Breakouts, when strong and successful, usually have a second leg. So in other words, once the market breaks out, there's a pullback and then a second leg. And they often go for some kind of a measured move based upon the size of the spike or the size of the trading range from which they broke out. And breakouts often fail. And traders all the time have to decide what to do once they see a big breakout. So for example, if there's a news report or an earnings report on a stock, and the stock opens with a big gap up, you'll hear traders on television like Fast Money on CNBC. I don't get any money from Fast Money. I'm just mentioning them because it's a popular show. You'll hear the traders say, big gap up on news, do we sell it? And you're saying, wait a minute, why are they talking about selling a big gap up? Shouldn't they only be talking about buying? Not necessarily. They'll look at the big picture. They look at all the bars to the left. If the market is in a very strong bear trend, they'll assume that the breakout is just a buy vacuum up to test resistance, like maybe the top of a channel, and they'll look to sell. You'll also have other traders who'll say, big gap up, maybe it'll break out above the bear channel if it's in a bear trend. What a great opportunity to buy on strength, expecting follow-through buying. And neither the bulls nor the bears are all that certain. Remember, the 60-40 rule, most of the time the probability is between 60 and 40%. And that is really true. Anytime the market gaps up big, the market's trading, there will be institutions buying and other institutions selling. And you have to assume that both the bulls and the bears are profitable. Most institutions are. And how can both a bull make money buying and a bear make money selling at the same time? It's because of trade management. If they look at the big gap up, they'll say, I don't know, maybe 50-50 chance it'll go up or down. They will have to risk half of what they're going for in terms of reward. They'll have to decide where their protective stop is, and they'll have to go for a reward at least twice as big. They don't specifically say, oh, what do I need to get a positive trader's equation? How big a reward do I need for a positive trader's equation? And that's not what they do. They look at worst case stop, and then initially they'll go for a target twice that size. If the market starts to go their way without getting anywhere near their stop, they'll take a look at how far the market went against them before it started to resume in their direction. At that point, they'll base a target on the actual amount of money that they had to risk on the trade. One thing you'll never hear traders say is, oh, it gapped up and now it has a hanging man pattern or a dark cloud cover. Okay? Traders are not interested in that stuff. It's nice, right, to have a signal bar. It's much more important to have context. Where are you in the market cycle, and is the market at support or resistance? That is the overwhelmingly most important thing that you need to know as far as taking trades. And then next, you have to know how to manage your trades. For example, when you take the trade, if you're very confident that the trade is good and that there'll be follow through, chances are it will not go very far. So you probably have to scalp more, swing less, and go for a smaller target, maybe 1 times your risk. On the other hand, as is the case most of the time, you look at the chart and you say, oh, I don't know, maybe it'll keep going, maybe it'll reverse. Okay, when that's the case, you should go for a reward at least 2 times bigger than your risk. So when you see the market gap up or down on a report, remember, there are institutions who will buy that gap, and there'll be other institutions who will sell that gap. Both, if they see this identical trade 10 times, will be profitable because of their trade management. And it will have nothing to do with the doji bar or the candlestick pattern or any other thing in terms of reversal patterns or continuation patterns on candlesticks. Let me give you an example. Here's Nike, daily chart of Nike, and it was in a bear trend, not a strong bear trend. It's a channel. Channels are weak bear trends. Lower highs, lower lows, and then it gapped down big on a news report. I think it was an earnings report. And you look at perfect doji star, a very big bar with a perfect close right in the middle, no body. So candlestick traders get excited. Oh, wow, a doji star in a bear trend, this could be the end of the bear trend. It can, but if you watched Fast Money or any business show on that day, you did not hear any trader saying, oh, wow, big gap down and a doji star. If it goes above that bar, it's a buy. Nobody said that. What they said was, do you think it's cheap enough to buy? Do you think it's overdone? Do you think it's at support? Do you think the support's below and it has room to go on the downside? That's how traders talk about it. So it's not the doji pattern that they're interested in. They're interested in all the bars to the left. I don't have much on the left here, but in actual fact, this is fairly close to the bottom of a trading range, a support area. And very often, when the market has a big gap, it trades down to the support area, and all of a sudden, bulls appear. And you say, wait a minute, why didn't the bulls prevent the gap from happening? Well, if you're a bull and you think it's going to test support, why buy here if you think it's going to reach here? So they just wait until it gets here, and then the bulls start to buy. And the bears, if they think it's going to get to support, they're going to sell aggressively all the way down. Even if there's a gap, they'll sell the open, expecting it to go down a little bit further. They may only scalp, but they're going to sell. And this is what resulted. The bears probably scalped, bought back the shorts, and that lifted the market up here. And the bulls, when it got down to what they thought was support, they started buying, and it lifted it to here. Nobody was talking candlestick patterns. Candlestick patterns are for home traders, people like you and me, and they're part of the setup, but they're not the setup. The setup is the support and the resistance, all the stuff to the left. The signal bar is the doji pattern, but the reality is most institutions are placing bets and they're totally ignoring this bar. They don't care. They just are interested in whether or not the market is down to a support level. And then they place a bet. They take a chance. Here's a common situation where you have a bear breakout where the market flips to always in short. So we have a bear bar, another bear bar, another bear bar, and then a bigger bear bar. So we have a bear bar bigger than the one before and another bear bar and breaking out. we have lower highs, lower lows, right? So at some point traders say, it's a bear channel, it's not just a trading range. And at this point, by the close of this bar, most traders would say, yeah, I think it's always in short. It was pretty good, it was in a bull leg up here, and then a pretty good bull leg here, some buying here, but this strong 4 bear bar spike was enough to make me think that the bears have control and that the market is going lower. When the market's always in short, what do? You got to look to get short. In this particular case, we have an II pattern, a small triangle, and you could short below it, or you can say, I don't know, these bars they're good, and it's enough to make me think we're going lower, but the big picture is that of a weak bear channel, in which case the market will probably bounce, and I should be able to sell higher. But I don't know, maybe it'll accelerate to the downside. So traders can short below this bar, they can short at the market, they can short the close of this bar, right? But we have tails on the bottoms of the bars, so some buying. The bodies are big but not huge, so the bears are not all that strong. A lot of traders will assume that this bear spike will be followed by a pretty good pullback. And here the market rallied for about 10 or 15 bars. And it in fact formed a low four short in a bear channel. We had a push up here, okay, so that sets up a low 1. We had a second push up here, sets up a low 2, did not trigger. Then we had another breakout, a pullback, and a second breakout. So 4 pushes up, that makes it a low 4. You can also argue wedge bear flag, a push up here, and then 2, 3, 4. Doesn't matter, sometimes wedges have 4 pushes. In any case, this is probably going to be a bear flag. Traders could short, as I said, the close of the breakout bar. As soon as they decided it was always in short, they could sell there. They could sell below this bear bar. But they're looking for a swing. The market's in a bear trend, and they just decided at this moment that it's in a bear trend. So they're looking for a swing. And where does their stop go? Above the top of the spike. You could put it above the most recent lower high, or above the top of the bear spike. The bear spike began with this bear body. To me, I would probably put it above the top of above the lower high. And once you decide that it's always in short, you keep looking for opportunities to sell until the market becomes always in long. And here we formed a triangle, 3 pushes up, 1, 2, 3. You can call it a triangle, you can call it a tight trading range, you can call it a double top bear flag. It does not matter. But what does matter is it's always in short. It did not become always in long. So the bet is that it's going lower. And you look for reasons to short. And it's better to short below bear bars, but when you have a low 4 setup in an always in short market, you can short below a bull bar here. Here we got a bear bar closing on its low after a little rally. It's a sell. Here we have a couple bear bars, and we have a doji bar here. You can sell below these bear bars, another breakout. Bear bar closing on its low after a pullback to the moving average, it's a short. Bear bar closing on its low, relatively big bar, that's a short. Another big bear bar closing on its low, that's a short. Even though it traded up here, it's still a short. And you trail your stops above the most recent lower high. So every time the market goes to a new low, the stop goes above the most recent lower high. So at this point, it fell below a low, so this stop goes down here. Here we broke to a new low, so the stop would move from here down to above this double top. The point of this slide is whenever you have a breakout and the market converts clearly to always in short in the eyes of traders, you can short for any reason, but if the breakout is not all that strong, you have to rely on a protective stop that is above the top of the bear spike, and that sometimes means you'll have a rally that goes on for more bars and covers more points than what you might normally expect. But that's still okay. You know, you decided it's always in short as long as it stays below the top of the bear spike, and as long as it does not clearly become always in long, it's short. And you can keep shorting and you rely on your protective stop. Here's a weak bull breakout, and because it's a weak breakout, you have to expect that you might get a deep pullback. the market sold off sharply here and became always in short, probably on this bar or this bar, and it immediately reversed up after testing near yesterday's close. Yesterday was a bear channel, big gap up, breakout, and 3 pushes down, 1, 2, 3. So this could simply be an opening reversal, a pullback from the gap up breakout above this bear channel. So we have a bear channel, bull flag, breakout, and then a very deep pullback almost down to yesterday's close. In any case, at this bar, you might think, oh, this is not good for the bears. A strong bull bar, big bar, closed near its high, and then a follow-through bar. And then we have another bull breakout. Its close is above the high of the prior bar. So most traders at this point would say, yeah, I think the bulls are in control, and that the sell-off was just an opening reversal. It's just a sell vacuum test of support in the area of yesterday's close. So at this point, traders are always in long. So that means they're expecting at least a second leg up, and they're going to look to buy pullbacks. They can buy this close, they can buy above the high of the prior bar, they can buy for any reason, but their stop is below the bottom of the bull spike, which would be the bottom of this big bull bar, or possibly the most or the low, right? So some traders will say it goes below the bull bar, others will put it here. It doesn't matter. The further the stop is, the more likely you'll be successful. However, when you have a 3-bar bull spike that looks like this, small tails gapping up, this bar closes above that bar, this bar closes above that bar, this bar closes above this bar, and we have lots of signs of strength that the breakout is strong. Most traders would not want the market to come back below the bottom of the spike. In fact, most traders would not want the market to fall more than a tick or so below the top of the signal bar. So anyway, when you're seeing the market flipped always in long, then you see doji, bull breakout, but a big tail, another bull breakout, but a big tail, more tails. At this point, you're thinking, yeah, this could just be turning into a trading range day. You know, big down, big up, big confusion. Confusion equals trading range. In any case, it's still always in long, so traders are expecting a pullback, but at this point, they're probably thinking the pullback will be deep, and it probably will be trading range type behavior, falling below prior minor higher lows. As long as it stays above the bottom of the spike, though, and as long as it does not clearly become always in short, it's still always in long, so you can buy for any reason. So we have a bear breakout on this bar. We have some follow through here. The bulls will say, yeah, it's okay, but it's not nearly as strong as this. It's still always in long. I'm going to buy the close of this bear bar. I'm going to buy the close of this bear bar. I'm going to buy above its high. And that's what the bulls are thinking. The bears, on the other hand, are thinking, well, we had a very strong bear breakout initially. We have another lower high. So we have a high, lower high, lower high, low, lower low, lower low. So at this point, we're still in a bear trend. We're forming lower highs and lower lows, a pretty broad channel. But in their minds, they're still willing to short. Maybe if it gets above this high or this high, they'll think, maybe a trading range and not a bear trend. But they'll still look to short. So all through here, in fact, all through here, both the bulls and the bears are active, and both you have to assume are profitable. You know, you have to assume that institutions are profitable, and at any given moment you have institutions buying and you have institutions selling, and both are going to make a profit. When the market is unclear, as it is today, right? Traders know, or the institutions know, that whenever it's unclear, the probability is around 50%, maybe even 40%. But in either case, any trade that they take, they know that they need to go for a reward at least twice as big as their risk to have a positive trader's equation, to have the math work out on the trade. So the bulls will buy anywhere through here, and they'll go for a reward twice their risk. The bears will sell anywhere in here. Who knows where their stop is? It may be all the way up here, right? And they'll scale in higher. So, you know, they'll short here, and they'll short here, they'll short here, they'll short here, and you know, they're managing their trade. The bulls, you know, they're buying. They bought all the way up through here. They buy here, they buy above here, they buy here, and they buy this bear breakout, and they buy this, right? So the bulls are buying, the bears are selling, but both sides are managing their trades. Probably most are scaling in. If you're a home trader, an individual trader and you saw this always in long, you'd probably buy that close. You might buy this, but you'd look and say, yeah, it's good. It's enough to flip it always in long, but it's not all that strong, so there probably will be a deep pullback. Had you bought this, you might have scalped out for 20 or 30 ticks, expecting a deeper pullback. Had you bought it and you did not scalp out, and you traded small enough, you would have looked to add on during a pullback. So you may have bought more here. If you bought here your full size position, and so you could not scale in long, and let's say you did not scalp out here, you'd hold long through this pullback and rely on your stop, looking for a second leg up. The market has an obvious second leg up here, but a 2-bar reversal, bear bar near the high of the day, probably at this point you're concluding the day is a trading range day. The follow through on the buying is just not good enough, so it's probably a bull leg and a trading range rather than a bull leg and a trend. So had you bought here, you probably would get out of your final position here, maybe take out half here and go to break even on your stop, and it looks like this came pretty close to testing the stop. So the point of the slide is, when you see the market flip to always in long, you have to be expecting a second leg up. We got the second leg up here. And if it's always in long, you can buy at the market as long as you put your stop in the appropriate location. If the stop is too far, you have to trade smaller so that your actual risk is the same. So don't get upset. The market. This is the day that you have. You have to trade the market that you have, not the one that you want. Sure, you want a strong, much stronger bull breakout. You want the 5 or 6 bars closing way up here. That's not what you have. This is the market that you have. You have a weak bull breakout, but always in long, so we should get a second leg up. And you got it at this point. So whenever the breakout is not all that strong, you have to assume that there'll be a deeper pullback. And that's okay. It's still tradable. And what are the advantages of trading breakouts? The probability is very high, and the reward is very high. Breakouts often lead to trends that have a lot of follow-through. The trend, you can have a bull breakout and it can just trend up and up and up and up and up for many, many, many bars. So you can have a huge reward. Disadvantage of a breakout: if you have a strong bull breakout that goes up for many points and then starts to channel up, and you enter somewhere in that breakout, your stop goes way below the bottom of the breakout, and that means that the risk can be very big. And if your stop is far away, you have to reduce your position size. And trading breakouts is often very difficult emotionally. Difficult emotionally because the risk is bigger than what you're accustomed to experiencing, and the risk grows as the spike grows. You have to reduce your position size, so you have to change what you normally do. It can be happening very fast. It can be scary. It can be stressful. And you have to change decisions with every tick. Where's your stop? Where's your profit target? You start scaling out. It often feels like there's not enough time to make trade management decisions. What kind of management decisions do you have to make? Whether to enter the trend or not. How far away should the stop be? Should it be all the way at the bottom of a bull spike, or maybe halfway, or below some one big bar within the bull spike and not below the entire spike? Your position size, you have to change that if your risk is bigger. Profit target. Since the trend is strong, you have to do some calculating as to what a reasonable target is. Instead of just going for a scalp, you probably should swing for a target that's much larger than what you typically try to attain. Breakouts are extremely common. Remember, every trend bar is a breakout. In a trend, the market's always trying to reverse. So a reversal is an attempt at a breakout in the opposite direction. So if you have a bear trend and you have a reversal, it's an attempt to break out of the bear channel and into a trend in the opposite direction. However, the markets have inertia, and they tend to continue to do what they've been doing. If they're in trading ranges, 80% of attempts to break out will fail. Once they're in a trend, 80% of reversals will fail, and the reversals just become pullbacks. So if you're in a bear trend and you have a reversal attempt, 80% of the time it'll become a bear flag and the trend will resume. Remember, most trend reversals fail and become pullbacks. So if you have a breakout and it's failing and trying to become a reversal, reversals usually fail, and that reversal usually becomes a pullback, and then the trend resumes. Here's an example of a bear trend, and everything in green is a reversal attempt, and all of these reversal attempts failed and became bear flags, and the trend resumed. And as the reversals are happening, they look strong. For example, look at this one. You have two strong bull bars, failed at the moving average. Here you have a double bottom, it broke out to the downside, and you have a micro double bottom. The market went down here and up, and then down and up, and you have a bull bar closing on its high, a possible wedge bottom. However, it ended up being just two legs up, and there's a gap bar at the moving average, a low above the moving average in a bear trend, and you have a bear signal bar, so that's a good low two short. Two legs up, 1, 2. These reversal attempts, despite the strong bull bars, they failed. Here, trying to become a pullback from this breakout attempt, two pushes up, 1, 2, it failed, it sold off. Another reversal attempt, maybe a major trend reversal. We have a bear channel, a trend line break, a moving average break, and now a lower major trend reversal. Here's a second attempt at a lower major trend reversal. Maybe it's a wedge also, 3 pushes down. Good looking bull signal bar, it failed. Tried to make a two-legged pullback, 1, 2, and 2 pushes up, 1, 2, and the market was followed by a bear reversal bar and a low two short, and the trend resumed. Another micro double bottom here, and it became a low two short. 1 push up, 2 pushes up, small double top, it failed. Breakouts are extremely common. In trading ranges, breakouts are climaxes. They race up to the top of the trading range, they race down to the bottom of the trading range, and they fail. In a trading range, the breakouts usually lead to reversals, and then the market has a spike in the opposite direction. So it spikes to the bottom, and then it races to the top, tries to break out, and it reverses again. In trading ranges, you have buy vacuums that suck the price up to the top of the range to test the top, and there's no follow through, there's no second leg. The market then reverses and gets sucked to the bottom of the range in a sell vacuum, and eventually the range breaks out and enters a trend, but that happens only about 20% of the time. 80% of the time, the inertia will continue, the trading range will continue. Above every bar on the chart, there are very smart traders, institutional traders, buying, hoping for a successful breakout. Usually, there are more traders believing the exact opposite and are selling, and therefore most breakouts sell. Most breakouts fail. So if the market goes above the high of the prior bar, most of the time there will be more sellers than buyers up there. If it goes below the low of the prior bar, it's trying to break out below, most of the time there'll be more sellers than buyers. Below every bar, there are smart traders selling, hoping for a breakout. Usually there are more traders believing the opposite, and they are buying, and most breakout attempts fail. Since failed breakouts are common, traders must be looking constantly for edges, mathematical advantages. To make money, you have to have an edge. You have to have a mathematical advantage. You need a positive trader's equation. And given that most breakouts fail, you have to take that into consideration when you're looking for trades. Failed breakouts are extremely common, and if a trader believes that buyers will win above the high of the prior bar or below the low of a prior bar, he should buy. If he thinks that sellers will win, he should sell. If he thinks there are more sellers above the high of the current bar, he should sell up there. If he thinks there are more sellers below the low of the current bar, and if he thinks there'll be follow-through selling and a trend, then he should sell. If he's not really sure, he should wait. When in doubt, it's always better to wait. Will a breakout be successful or will it reverse? This is the single most important concept in trading, and it's the basis of everything that we do. Every entry, every protective stop, every profit-taking limit order, everything that we do as traders comes down to deciding whether or not a breakout will succeed or fail. Remember, every trend bar is a breakout of something, and every breakout fails sooner or later. For example, every tail on the top of a bar is a failed breakout. If you have a tail on the top of the bar, at one point it was a strong bull trend bar, and that tail means that the market failed in its attempt to break out. If you have a tail at the bottom of a bar, the bar went down and then it went up. So it was a failed attempt to create a bear breakout. When there's a failed breakout, you can either get a reversal or a pullback and then a resumption to a new trend. For example, if you have a bull trend and the breakout fails and it starts to turn down, either the reversal can continue down or it can continue down just a little bit, become a bull flag, in other words a pullback, and the trend resumes. You're constantly deciding whether a breakout will fail and create a reversal, or if it will simply become a pullback and result in follow through in the direction of the trend. And if you can decide that either is more likely, a reversal or continuation, then you have an edge. You have a setup with a favorable trader's equation. After the close of every bar, the most important question a trader asks himself is, will there be more buyers or sellers above the bar? Will there be more buyers or sellers below the bar? Breakouts are important because they can lead to an always-in move. In other words, if you have a downside breakout and it becomes clear that the market will continue down, the market has become always-in short. And that's important to know, because then the trend will probably last for many bars, and you should not be scalping. You should be going for a swing trade. The trader's equation in that case is very, very positive, very, very favorable for shorts. Whenever you see a breakout, it's a three-step process. First, there's a breakout, for example, a bull breakout. Then there's a failure, an attempt to make the breakout fail. And then the market will either resume the breakout or it'll lead to a reversal. So you'll either get a reversal or a resumption after the failure. What constitutes a successful breakout? Well, one thing is the trade was profitable. Another thing could be that the trader was satisfied with whatever happened. Okay, what is the breakout? It's a trend bar or a series of trend bars. That's the first step in the three-step process. Eventually, there will be an attempt to make the breakout fail and reverse. So let's say you have a bull trend bar, another bull trend bar, another bull trend bar, and then a bear reversal bar. That is the failure of the breakout. And at that point, the breakout will either reverse or pause, become a bull flag, and then resume. So that failed breakout attempt either leads to a reversal of the breakout and a trend in the opposite direction, or simply a pullback, and then the breakout resumes and becomes a trend. The red boxes are weak breakouts. Remember, every trend bar is a breakout. So here's a breakout attempt, another one, and here's the failure, the big tail, and the market tried to go up. Didn't go very far, and it became a pullback from the breakout. So we broke below this bear flag, probably below yesterday's low. Not a very strong breakout. We got an attempt to reverse. This attempt to reverse failed, and it became simply a pullback in the bear trend. We have a strong bear breakout here, but look what followed. A bar with a very, very big tail. So that is the reversal attempt for this breakout. Here's another breakout. You have two strong bull bars. You have a third bull bar with a big tail, and now we have a reversal attempt. The reversal attempt became a breakout pullback. BP, breakout pullback, a pullback from the breakout. Another strong breakout, another attempt to reverse. The attempt to reverse failed, and it became simply a pullback, a breakout pullback. So you got a breakout and a pullback buy setup. Here we have bear bars, so they're attempts to break out, but they're not going very far. Here we have a bull breakout, but it's also very weak. Small bars and tails. It did not go very far. Here's another bull breakout. Did not go very far. Bear breakout did not go very far. Here's a bear breakout and went down for several bars, enough room for a trade. Here's a bull breakout, also small bars, but there was enough follow through for a profitable trade. Here's an attempt to make the breakout fail, and instead we got a 1 bar bull flag. How do you know whether or not a breakout will succeed or reverse? You have to compare the strength of the breakout with the strength of the reversal attempt. You have to decide, are the bulls or bears stronger? If one side's clearly stronger, it's more likely to control the move that follows. If both the bulls and bears are equally strong, you need more information. And that information comes from the next bar or next several bars. So just patiently wait until you get some clarity. Alright, photographic memory test. Be ready. This is going to be fast. What are the signs of a strong bull breakout? There are many. What are the signs of a weak bull breakout? Again, there's a long list. The signs of a strong bear breakout? Again, many, many, many. Signs of a weak bear breakout? Again, many, many in the list. Here's an example of a strong bull breakout, and here are some of the characteristics that make you conclude that it's strong. First of all, you have large bull trend bars, and you have several in a row. They're closing near the high. They're closing above the high of the prior bar. For example, this bar closed above the high of this bar. This bar closed above the high of that bar. So that is a gap. This bar closed above this high. That's another gap. There's also a low above the high of the bar before this bull bar. So that is a gap. That's a sign of exceptional strength and urgency. You have a bull trend bar, a breakout, and the low of the bar following it stayed above the high of the bar before it. So that's a gap over here. The context also makes sense. We're reversing the low of yesterday. You also have to be looking for measured moves based upon the height of the initial spike. Also notice that there's very little overlap among the bars. Up here, lots of overlap among the bars. So the bear breakout didn't go far, the bull breakout didn't go far. Strong bull breakouts look like this. There's also closes around and above resistance. Bear trend lines, a close above prior swing highs, closes above the moving average. Again, signs of a strong bull breakout. Here's a strong bear breakout that failed. A very big bear trend bar, but the very next bar has a bear body, good for the bears, but it has a huge tail and led to a reversal up. So this was an exhaustive sell climax, and it's an example of a strong bear breakout that failed. Traders might buy above its high. Certainly by the time this bar closed, traders would have decided that the market's always in long, and they would be looking to buy. They'd buy the close here, they'd buy maybe the close here, they'd buy at the low of this bar, and they would have been filled on this bar. They would buy above the high of this bar, they'd buy this close, they'd buy this close, they'd buy below that bar, they'd buy above this bar. Here's an example of a weak bear breakout. It failed. You have a very strong bull trend, and you have a double top, a strong bear reversal bar here, too much buying pressure, too much strength here to go short. But here you have a 2-bar reversal, up bar, equally strong down bar, so you can look at it as a second entry short. So the bears are trying to create a downside breakout, but it's weak. Okay, we only had one strong bear bar, not 2 or 3 in a row. You have another strong bear bar, but no follow through. Also, the bars are actually fairly small compared to the size of the bull bars. And the context is bad. This is a strong bull trend, and there has not been significant selling pressure. No breaks below the moving average, no earlier strong bear spikes, so the context is bad for a reversal. Also, no gaps. This bar is a bear trend bar, but it did not close below the low of the prior bar. This bar did close below the low of the prior bar, so there is a gap, but it immediately reversed on the next bar or two. There's also no close below significant support, no close below the moving average, no close below a prior higher low. If there is a strong bull breakout, you want to buy. There's a module later on that talks about how to trade strong bull breakouts. In general, you need to get long. You need to buy at the market or at the close of bull bars and at the close of bear bars. A bear bar is an attempt to make the breakout fail. 80% chance that attempt will fail. So you can buy the close of any strong bear bar. You can buy below the low of the prior bar, assuming the reversal attempt will fail. You can buy above the high of the prior bar, viewing the prior bar as the end of a pullback. You can buy the breakout of any kind of a bull flag. If there's a small bear channel, it's a bull flag. You buy the breakout of that bear flag. Excuse me, that breakout of the bull flag, the bear channel. Remember, every bear channel is a bull flag. So how do you buy a pullback and a bull trend? If the bull flag appears ready to break out to the upside, you place a buy stop at one tick above the high of the prior bar, so that if the market goes above the high of the prior bar, you get stopped into a long position, so you're swept into the trade by the momentum of the trend resuming, which is a great way to enter a trend. So remember, if you have a breakout pullback in a new bull trend, the bears will soon attempt to make the breakout fail and reverse back down, and that's what generates the pullback. If they're unable to reverse the breakout, the rally soon resumes, and that reversal attempt becomes just a pullback in the bull trend, a bull flag. If there's a strong bear breakout, you have to sell, and you have to sell early. Once you think that there's a strong bear breakout, you've got to get short. You can sell at the market. You can wait for the close of a bull bar or a bear bar. If you have the close of a bear bar, you're selling on strength. If you have a bull bar occurring in a strong bear trend, you have to assume 80% chance it's going to be a failed reversal attempt, so you can just sell the close of that bull bar. You can sell above the high of any bar, because that would be an attempt to make the strong breakout fail, and 80% chance that will not succeed. If you get a pullback, you can sell below the low of that bar, because that pullback becomes a small bear flag. If you have a bigger bear flag, you can sell on a breakout of the bear flag, because it's a high probability short entry, expecting the trend to continue down. So if you have a pullback and a bear trend, you got a bear trend and a pullback, you look to short on a stop. You place a stop order, a sell stop order, at one tick below the low of the prior bar. As soon as you see a bear flag that you think that might be ready to break out to the downside, you place that stop order, hoping to get swept into the trend as it resumes down. What about a pullback in a breakout in a new bull trend? Eventually the bears will try to make the breakout fail and reverse back down. They probably will be unable to reverse the trend, and the rally will resume, and their reversal attempt will become simply a pullback in the bull trend. In other words, a bull flag. All bull flags are reversal attempts by the bears, and you have to assume that the bears will fail and the trend will resume. If you have a new bear trend, breaking out, at some point the bulls will attempt to make the breakout fail and reverse back up. 80% chance they will not be successful. They should be unable to reverse the breakout, and then the sell-off will resume. Their reversal attempt will become simply a pullback in the bear trend, and therefore a bear flag. So here we have a bull trend, and many attempts to make it reverse. Here's an attempt to make it reverse, a possible final flag, and the reversal attempt simply led to a 5-bar bear microchannel. It held above the moving average, and therefore was a bull flag. Here we got a strong bull reversal. The market probably went always in long in the eyes of most traders over here, so they'd be looking to buy. They'd be looking to buy at the low of the prior bar and above the high of any pullback bar, so they'd buy here. Small pullback, traders will buy above it. A two-legged pullback, traders will buy above this. So here we have a high 2 bull flag. We have a breakout from it, and we have a pullback. Traders will buy this pullback. We have another breakout. Traders will place buy stops above the high of the prior bar and buy there. Another attempt to reverse, possible final flag, not a strong reversal. Traders will buy above the high of the attempt to reverse. A little wedge bull flag, a little pennant. They'll place a buy stop 1 tick above the high of the prior bar and get long again. Here's a better looking attempt by the bears to create a reversal, but the channel up is still very tight, not much prior bear strength. This will probably fail. We had a push down here, the bears had a second push down here, and a third push down here. You can call it a triangle or a wedge, doesn't matter. It's a bull flag and a buy setup, especially when you have a bull signal bar here at the moving average. Each of these arrows are strong buy signals. You place a buy stop 1 tick above the high of the signal bar, and then you enter on the following bar. Here's a bear trend, and lots of attempts to make the trend fail. We are down for 6 bars and tried to reverse. Instead, it failed. Here the bear is becoming more convincing, probably always in short. We had a gap up, and it looks like it's failing. Traders will look to sell. Here's a pullback. They'll place a sell stop 1 tick below its low. Here we have 2 pushes up, a push up here, and then down, push up here. So you get a low 2 short at the moving average. Traders will place a sell stop at 1 tick below the low of that bar, and they'll get filled here for a scalp. Here we're trying to reverse up. Maybe we're getting a double bottom with the low of the day. We have 3 strong bull bars. So it's possible traders will view this as a new bull. They'll try to buy above the high of the bar, buy above the high of the bar, buy above the high of the bar. Here, maybe we're pulling back from this attempt to rally. They might buy above the high of this bar as well. 2 legs down, 1, and then a bull bar, and then 2. But it failed. Here, clearly a bear trend. We're breaking out below the prior low, and we have a series of bear bars. We have a bear micro channel, and traders will expect the bull breakout of the bear micro channel in the bear trend to fail, so they'll look to short below the low of the prior bar. Here's a pullback. They'll place a sell stop at 1 tick below its low and get filled there. Spikes, which are breakouts, are common. We have bear spikes in red and bull spikes in green. So breakouts can succeed or fail. Here's a bear trend. We had several bear breakouts along the way. And here's a very strong bear trend bar occurring 20 or 30 bars into the trend. However, look what followed. A trading range and then a reversal. So a very strong trend bar at the end of a long trend can be an exhaustive end of the trend. Ultimately, actually, this is effectively an exhaustion gap. I'll talk more about that later. We gapped up, and now we're starting to break out to the upside, and now we have a very strong bull trend bar occurring after the trend has gone on for 30 or 40, 50 bars, and in this case it led to another leg up in the form of a channel. So we had a spike up and a channel. So a big bar late in a trend can be an exhaustive end of the trend, or it can lead to a new leg up. Okay, here's a breakout, and the breakout is strong. We have a strong bear bar here, a big bear bar, small tail, another bear bar, follow through, another bear bar, and not all that much overlap among the bars. And there's immediate follow through, and it's also a logical location for a breakout. A trading range for the first hour or so of the day, and now we're getting a breakout. Maybe the range will double. On the other hand, compare what took place over here with these big bear breakouts bars and the signs of strength on the part of the bears. Compare that to what's taking place over here. Okay, we have bull bars. We're trying to get bull breakouts, but there's no follow-through. Right after the bull bar, you get a doji bar or a bear bar, so you get bars in the opposite direction. The market's largely going sideways. It's also a logical area for a failure. We had a very, very strong bear trend. The reversal up is not all that impressive. It's not a series of very strong bull bars. Probably this is all simply a pullback in this very large bear trend. So logically, it's more likely that this is going to be a pullback that would lead to a resumption of the trend rather than a sharp reversal up. So the context is bad for a breakout. Trend bars are many things. Every trend bar and every series of trend bars is a breakout of something. And I often refer to strong breakouts as spikes. But every trend bar and series of trend bars is also a gap, whether or not it is easily apparent. Every trend bar is also a climax. A bull trend bar is a buy climax. A bear trend bar is a sell climax. So every trend bar and every series of trend bars is a breakout, a climax, a spike, and a gap. And it functions as one of those things, one of those four things, depending on context. Here we have a breakout, so the trend bar is a breakout. Here we have a series of trend bars functioning as a spike. Here we have a big bear trend bar trying to break out below the prior low, but it ended up as an exhaustion gap. The low of this bar, the high of this bar, there's space between, so this bar is a gap. However, it marked the end of a bear trend. Here we have a buy climax, a very strong bull trend bar. It could be the start of a new breakout. Instead, it was a failed breakout attempt at the top of a trading range, and it became a buy climax and an exhaustion gap. Here's a gap, the high of this bar, low of that bar. There's space in between, so this bar is a gap. It might have been a measuring gap leading to a measured move up. Instead, it filled over the next few bars, and the market turned down from the top of a developing trading range, and it became an exhaustion gap. Here we have another trend bar, and there's a gap. The high of the bar after it is below the low of the bar before it, and it's at the start of a trend. It might be a measuring gap, and in fact, so if you take the start of the move right here, and you put a measurement in the middle of the gap, it projects down here, and the trend reversed just below this measured move from this measuring gap. So that is a trend bar functioning as a gap. Here's the S&P, or the E-mini chart on the right, the futures contract, and it gapped down. So there's a big gap here. However, this is the cash index. Same chart, and instead of a gap, there's a trend bar. So you should think of every trend bar as a gap and every gap as a trend bar. Here's a more obvious example. Here's the FAS, which is an ETF based on the financial stocks. And here's the RKH, which is a similar financial ETF, but much less volume. So there are lots of gaps on the chart. Compare the two. The two charts look identical, except that here we have gaps, and here we have a trend bar. Here we have a couple trend bars. Here we have a gap. All right. This gap turned into a measuring gap. The start of the move to the middle of the gap led to a measured move up. These two trend bars created a measuring gap. Even though they're trend bars, they're a measuring gap, and leads to a similar move up. So I think of every trend bar as a gap, and if you look at a comparable chart with thin enough volume, it'll actually appear as a gap. I also think of every gap as a trend bar. If you look at another chart of a similar market, but with much bigger volume, instead of a gap, you'll see a trend bar. Another example, bar 4 is a bear trend bar. Over here, bar 4, there was a gap down. Here we have a big bull spike up on the way to 5, many gaps. Over here it's a series of trend bars. So in my mind it's interchangeable, gaps and trend bars. Every time I see a trend bar I assume it's a gap. So what are the types of gaps? On a daily chart we have actual gaps that you can see. At the start of a move there's a breakout gap. Halfway into the move you'll get a gap that often leads to a measured move, so it's a measuring gap. At the end of a move you'll often, for example on a bull trend, get a gap up and then the trend reverses down. That's an exhaustion gap. As if you have a bear trend, every now and then it'll gap and then gap again and gap again. Those are just common types of gaps. And then there's another type of gap that I call a micro gap. I'll talk about that soon. When the market's having a bull breakout, there'll be a trend bar, and it probably will close above the high of the prior bar. If the next bar has a low above the prior bar before the breakout bar, there's a gap between those two prices, and that often becomes a small measuring gap, and that gap, since it's at the start of a bull move, is a breakout gap. If there's a new bear breakout and you have a bear trend bar that closes below the low of the prior bar, and then the bar following has a high that is also below the low of the bar before the bear breakout bar, that is a small gap, and it's a breakout gap, and it often becomes a small measuring gap. Here's an example. We have a bull breakout, possible bull flag, a bear channel, bull flag, and the close of this bar is above the high of the prior bar, so there's a gap, and the low of the bar after the bull trend bar is above the high of the bar before it, so there's a gap between this low and this high, and that's a possible breakout gap leading to a bull trend. On the other hand, here we have a bear bar closed below the low of the prior bar. We have a second bear bar closing below the low of the prior bar, and then this bar is an attempt to reverse, but its high is below the low of the bar before the bear spike began, and that is a gap, and this could be a breakout gap leading to a bear trend, which it ultimately became. So what is a bull measuring gap? Let's say you have a bull trend bar forming after a trend has gone on, a bull trend has gone on for a long time, 10, 20, 30 bars. And you look at that bull trend bar and you notice that the high of the bar before it is below the low of the bar after it. So there's a little gap. That gap, that bull trend bar is the gap. And that gap might lead to a big measured move. It might become the middle of a very big bull trend. A bear measuring gap, if you have a bear trend that's going on for a long time, and now you have a bear trend bar, and the low of the bar before it is above the high of the bar after it, that bear trend bar is a gap, and that gap might end up being a measuring gap. It might be the middle of the bear trend, so the market might have a lot further to go. So here's an example. When you have a bear trend that's been going on for 20, 30 bars, and then you have a bear trend bar, so a new breakout, and look at the low of the bar before it and the high of the bar after it. This red rectangle is a gap between those two prices. This trend bar then becomes a gap, and it might end up becoming a measuring gap. So you look at the start of the trend up here, you look at the middle of the gap, and you project down the same number of ticks, and it takes you here, and that's in the area where the trend ended. So traders will look to take profits down here. Aggressive traders will look for some kind of reversal pattern. What about an exhaustion gap in a bull? So let's say you have a bull trend that's going on for 10 or more bars, and it's at a resistance level where the context is good for a big pullback, and you suddenly get a bull trend bar, a big bull trend bar closing near its high right up to that resistance level, and then within a bar or two it fails and reverses down. That big bull trend bar can be an exhaustion gap. A bear exhaustion gap, you have a bear trend and it's getting close to support, and then you suddenly have a very big bear trend bar closing near its low, right near support. It reverses up in the next bar or two. That big bear trend bar is a sell climax and an exhaustion gap. So here's an example. We have a bear trend that's going on for a long time. And now we have another bear trend bar closing on its low, and its close is below the low of the bar before it. We're at support, right? We're at a measured move target, and now we have a renewed breakout. Traders will wonder if this breakout attempt will become an exhaustion gap. In other words, they're wondering if the next bar will get above the high of the bar before it, closing the gap, which is what took place. We're also at the support of a trend line. So we're at a trend line, in this case a trend channel line, because it's below a bear trend, and we're at a measured move target, and we have a possible final flag after an exhaustive sell climax with consecutive sell climaxes. Sell climax, sell climax, sell climax. Remember, every trend bar is a climax. Sell climax, again, again. Once you have a series of consecutive sell climaxes, you have to start looking for a possible end of the trend and a reversal up. Common gaps. Every trend bar is a gap, and trends have lots of trend bars and therefore lots of common gaps, and they have no particular predictive value. They're especially common in trading ranges. You have lots of trend bars that just don't lead to anything. Again, every trend bar is a gap. There's more chance of follow through if the low of the bar after it is above the high of the bar before it. There's a sense of urgency here, so it's more likely that we'll get follow through. However, when the market's in a trading range, you get gaps down, trend bars down, you have trend bars up, and they're meaningless. Most fail and just result in churning sideways price action. And what is a micro gap? For every trend bar, look at the bar before and the bar after. If they do not overlap, the odds of follow through are greater. I gave several examples of micro gaps earlier. So here's an example. We have a bear trend bar. You look at the low of the bar before it as resistance, and if the bars after do not go above the low of that bar, this is a micro gap, and it increases the chances that there'll be more follow through. Here's a bull breakout, and here's a pullback, but the pullback stayed above the high of the bars before it, so there's more chance of follow through. Here's a bear breakout, the low of the bars before it, the highs of the bar after it, a huge gap, probable follow through. Another gap here, a bear trend bar, the high of the bar after is below the low of the bar before, so a micro gap increases the chances of follow through. Same here, same here. So a micro gap is a sign of strength if the gap stays open. If a micro gap closes, follow through becomes less likely. So for example, we have a gap down here, a trend bar here, a low and a high. There's a gap in here, but it closed on the next bar, so chances are not much follow through. Here's an attempt at a micro gap, the low of the bar before, the high of the bar after. There's a gap in between, it closed, and the trend afterwards was not all that strong. And all of these red lines are examples of micro gaps that closed and not much follow through strength. Here's a bear micro gap, right? And it closed and it led to a reversal. So if a micro gap stays open, it's a sign of strength. What about consecutive climaxes? I mentioned that a moment ago. Every trend bar, every series of trend bars is a climax. If you start to get a series of consecutive climaxes without a pullback, you should soon expect TBTL, 10 bars and 2 legs. It's not always exactly a 10 bar correction, but at a minimum there should be 2 legs. It might be 3 or 4 legs. It might be a reversal, and that pullback should have at least 10 bars. So anytime you have a series of climaxes, you have to start looking for a correction, and the correction probably will have at least 10 bars and at least 2 legs. Here's that chart that I showed earlier. Each one of these red boxes is a sell climax, a trend bar, or a series of trend bars, and you have to start thinking that, wow, this is going too far too fast without a correction. So once a correction begins, you have to start thinking, well, the correction probably will be bigger than what people expect. It should have at least 2 legs and have at least 10 bars. This is a parabolic move. You connect the lows here, you have that slope, and then you connect the new lows, and the slope is getting steeper and steeper still, and it's after a series of consecutive sell climaxes. Possible final flag, since it's a low 2 occurring late in a trend, that often leads to a final flag. Here's a final flag buy setup, a 2-bar reversal. This could be the start of at least 2 legs up and 10 bars up. And this is what followed, actually a very strong reversal up. Minimum target is 10 bars, 2 legs. Here we have 2 legs. We have 1 leg up here, pull back, second leg. Here we kept going up. So the minimum was 2 legs and 10 bars, and we got much more than the minimum after a series of consecutive sell climaxes. What is a climax? It's a late, strong breakout, late in a trend, after 30 or more bars. If you suddenly get, for example, let's talk about a bull climax. If you have a bull trend going on for 30, 40, 50 bars, and then you suddenly get the best 2 looking bull trend bars in the entire trend, you have to think that it will attract a lot of profit takers. So the bulls who bought earlier will see this as a windfall, a wonderful opportunity to take profits at a great surprise price. The bears will also see it as probably a brief opportunity to sell at an exceptionally high price. So you might have both the bulls and bears selling, and that could be the end of the trend. So for example, you have a bull trend that's been going on for about 40 bars, and now you suddenly have a strong bull breakout. And it's the best looking bull trend bar, or the best looking 2 or even 3 bull trend bars of the entire trend. It could be a climactic end to the bull trend, especially if the bull trends or trend bars are very strong, closing on their high. The bulls have a lot of open profit, and they're looking for a reason to exit. And they see this as a gift, a surprisingly big final profit. And they would not be taking profits if they were expecting just a little pullback, right? They held on for 20, 30, 40 bars. If they think this correction is only going to be 2 or 3 bars long, they'd continue to hold. They're only taking profits because they're expecting a big pullback, at least 10 bars, at least 2 legs. And the bears know that, and because of that, the bears will start to short aggressively, knowing that they'll probably get at least 2 legs down and at least 10 bars down. So when you see these late breakouts, these very strong breakouts late in a bull trend, traders will be thinking of a possible climax. The bulls will take profits, and they'll not look to buy again until much lower. So there'll be an absence of buyers, for far below on the chart, and the market will get sucked down to some support level. And the bears will see this as a great opportunity to short at a very high price, expecting that there will not be buyers until the market gets much lower. Here's an example, very strong bull trend, and the trend's trying to resume, and we have the best looking bull bar of the entire trend occurring 30 or 40 bars into the trend. It might lead to a breakout and a resumption, but a lot of traders will wonder if it's an exhaustive end of the trend. So a lot of bulls will start taking profits on the close of this bar all through here. Bears will wonder if it's the end of the trend as well, and they'll start to short, and expecting at least 10 bars and 2 legs down. So we got 1 leg down here, maybe a second leg here. Doesn't look like a deep enough correction. So I think the bulls will want it to go down lower before they'll buy again, and we ended up selling off pretty consistently for about 20 or 30 bars. And you can also look at this as a possible higher high major trend reversal. We have a bull trend, a trading range. It broke the trend line. It broke below the moving average. And we have a resumption of the trend and a second attempt to reverse the trend. So this big bull trend bar late in the trend ended up being an exhaustive buy climax. It became an exhaustion gap once bars closed below the low of the bar before the trend bar, and it was also a higher high major trend reversal. Here's a second entry short. Here's a bear trend, series of bear sell climaxes, each of these red boxes, and then look here, the best looking bear bar of the entire trend. Traders will start to wonder if this might be an exhaustive end to the trend. So they might sell that bar, they might sell this bar as well. Incidentally, by the way, when I have these big bear spikes, if I'm looking to fade the move, I'll usually place my stop at a measured move down from the bear spike. So I measure from here to here and then put a protective stop that many ticks down. And a lot of times I'll scale in just above my stop level. And bulls obviously would be taking profits, and they will not be eager the bears will be taking profits, and they will not be eager to sell again until much higher. They're not going to take profits here and then sell again right here. If they sat through this much of a trend, they're not going to be selling, they're not going to buy back their shorts and then sell again right here, or maybe even right here. They're going to wait for a lot of bars and a lot of points before they're willing to sell again. And that's why after a series of consecutive sell climaxes without much of a correction during the sell-off leads to a very big rally. Here we have a series of consecutive buy climaxes, these red boxes. And then now we have two great looking bull bars closing on their highs. You can say, wow, it's going to break out into a stronger trend. On the other hand, more likely it's going to be an exhaustion move, a climactic end to the bull trend. And bulls will use this as a great opportunity to take profits on their take profits on their longs, and they won't want to buy again until the market goes down for at least 10 bars and 2 legs. Bears, on the other hand, will sell this close, expecting it to be the end of the move, and they'll look for a move down to at least the bottom of the spike, and there usually will be buyers there. The bears will buy back their shorts, so a lot of times you'll get a bounce there at the bottom, right below the bottom of the spike. This is also a higher high major trend reversal. We have a bull trend, a trend line break. I don't have the trend line drawn, but it broke the trend line. It tested the moving average, and it broke again to the upside and had a bear reversal bar. There's nobody left to buy here. The bulls are selling to take profits, and the bears are selling. Here's an example in a bear trend. Consecutive bear climaxes. Each trend bar, each series of bear trend bars is a climax. We have a two-legged pullback, and then we have a strong bear breakout, the biggest bear bar of the entire trend. That is a red flag to traders. Bears will see it as a great gift, an opportunity to take profit on their shorts at a great price. Bulls will see it as a great opportunity to buy for a scalp. They'll assume the bears will buy back their shorts and not look to sell again for many, many bars. So it's a great buying opportunity. That is the end of the module on breakouts and gaps.